October 29th, 1929. In just one day, $14 billion vanished. That's over $200 billion in today's money. Gone. But here's what nobody tells you. The crash didn't cause the Great Depression. It was just the match that lit a fuse that had been burning for years. And by the time people realized what was happening, it was already too late. Over the next decade, 1 in 4 Americans would lose their jobs, banks would collapse, families would starve, and an entire generation would be scarred forever. But this is the story of how the greatest economy in the world destroyed itself, and why the warning signs were ignored until it was too late. Let's break it down. The 1920s were supposed to be America's golden age. World War I was over. New technologies like automobiles, radios, and electrical appliances were transforming daily life. And Wall Street? It was printing money. Between 1924 and 1929, the stock market tripled in value. Everyone wanted in. Doctors, teachers, factory workers, people who'd never touched stocks before were suddenly day trading. Banks were offering loans so people could buy stocks on margin. You could put down just 10% and borrow the rest. But here's the problem. This wasn't real growth, it was speculation. People weren't buying stocks because companies were profitable. They were buying because prices kept going up. Classic bubble behavior. By 1929, investment trusts, basically the hedge funds of their day, were buying stocks with borrowed money to create more trusts to buy more stocks. It was a pyramid scheme on a national scale, and nobody wanted to admit it because everyone was getting rich, at least on paper. Meanwhile, warning signs were everywhere. Agricultural prices had been falling since 1925. Farmers were drowning in debt. Manufacturing was slowing. Wages weren't keeping up with productivity. But Wall Street, they ignored it all. See, there was a bigger problem: wealth inequality. By 1929, the richest 1% owned 40% of the nation's wealth. The bottom 93%, they were living paycheck to paycheck. When you have that kind of imbalance, your economy is one shock away from collapse. But in September 1929, the market hit its peak. The Dow Jones reached 381 points. Bankers were celebrating. Economists were predicting endless prosperity. And then everything changed, because what goes up on borrowed money must come down. October 24th, 1929, Black Thursday. The market opened and immediately panic selling began. 12 million shares traded hands in a single day, a record. Prices were in free fall. By noon, the chaos was so bad that trading was delayed. Major banks tried to stop the bleeding. A group of powerful bankers pooled their money and started buying stocks to prop up prices. It worked, temporarily. The market stabilized. Everyone took a breath. Crisis averted, right? Wrong. The following Tuesday, October 29th, Black Tuesday, the bottom fell out. 16 million shares traded. The Dow dropped 12% in one day. Fortunes evaporated. Millionaires became paupers overnight. People who'd borrowed to buy stocks now owed more than they owned. Here's what happened. Margin calls. Remember those loans people took to buy stocks? When prices fell, banks demanded immediate repayment. But people didn't have cash. Their wealth was in stocks. So they had to sell, which pushed prices down further, triggering more margin calls, a death spiral. By mid-November, the market had lost $30 billion in value. That's about $400 billion today. But here's the thing everyone gets wrong. Only 2% of Americans owned stocks. So why did the whole economy collapse? That's where it gets insane. Banks. Banks had lent money to stock speculators. They'd also invested their own money, your depositors' money, in the market. When the crash came, they couldn't collect on their loans, and their investments were worthless. They were bankrupt. And there was no FDIC, no deposit insurance. If your bank failed, your life savings disappeared. So when people heard rumors about banks being in trouble, they rushed to withdraw their money. This caused more banks to fail, which caused more panic. 9,000 banks would collapse over the next 4 years. By 1930, the dominoes were falling. Banks failed, people lost their savings, businesses couldn't get loans. They cut production, they laid off workers. Those workers couldn't buy goods. More businesses failed, more layoffs, a vicious cycle. By 1933, the unemployment rate hit 25%. 1 in 4 Americans couldn't find work, but that number doesn't capture the full horror. Another 25% were underemployed, working part-time or for reduced wages. Industrial production fell by 46%, construction dropped by 90%, the GDP collapsed by 30%. To put that in perspective, during the 2008 financial crisis, GDP fell 4%, and we called it catastrophic. Bread lines stretched for blocks. Soup kitchens couldn't keep up with demand. Families were evicted from their homes. Shantytowns, called Hoovervilles after President Hoover, sprung up in every major city. People lived in tents, cardboard boxes, abandoned cars. And then nature made it worse. The Dust Bowl. Years of over-farming and drought turned the grain plains into a desert. Massive dust storms, black blizzards, buried farms, killed livestock, and forced millions to flee westward. This was a depression in every sense: economic, psychological, social. Suicide rates spiked, marriage rates plummeted, birth rates dropped. An entire generation delayed their lives waiting for things to improve. And the government? President Hoover believed the market would self-correct. He opposed direct relief, thinking it would make people dependent. He cut spending and raised taxes, making everything worse. By 1932, people had had enough. Enter Franklin Delano Roosevelt. He won in a landslide, promising a new deal for the American people. And in his first 100 days, he passed more legislation than any president in history. Bank reforms, job programs, Social Security, agricultural subsidies. He threw everything at the wall to see what would stick. Did the New Deal end the Depression? Historians still debate that. What's clear is it stopped the freefall. Unemployment dropped from 25% to 14% by 1937. Banks stabilized. Hope returned. But here's the controversial part. The Depression didn't truly end until World War II. Massive government military spending finally pushed the economy back to full employment. It took a global war to fix what a speculative bubble created. So, what caused the Great Depression? Not one thing. It was a perfect storm. Stock market speculation, banking failures, wealth inequality, monetary policy mistakes, the gold standard, global trade collapse, agricultural crisis. Each problem amplified the others. The lessons are: first, speculation without fundamentals always ends badly. Second, banking regulations exist for a reason. Third, extreme wealth inequality makes economies fragile. Fourth, doing nothing in a crisis makes it worse. And fifth, deposit insurance, the FDIC, was created because of this disaster. The Great Depression killed the idea that markets always self-regulate. It proved that sometimes you need rules, safety nets, and government intervention to prevent catastrophe. That's why we have bank regulations, unemployment insurance, Social Security, and the SEC today. Could it happen again? We have more safeguards now, but if 2008 taught us anything, it's that new forms of speculation always emerge. The details change, but human nature doesn't. Greed, panic, herd mentality, these are constant. The